Hi everyone, welcome to Compounding Academy. Adobe defines its category. Creative Cloud powers everything from film editing to digital design, and now generative AI is the next leg of growth. With sticky software, recurring revenue, and strong margins, it's a durable business. Tools like Firefly enhance its edge and expand its reach. Let's explore why Adobe has compounded value for years, and why that can continue. We're in a major shift. AI is transforming how content is created and workflows are digitized and streamlined. Design, video, documents, it's all moving faster from idea to delivery. This shift sets the stage for Adobe's next chapter. Two powerful forces are colliding. First, demand for digital content is exploding across social media, marketing, education, and enterprise. Everyone needs more visuals, faster. Second, AI is unlocking new levels of productivity, turning time-consuming creative processes into near-instant workflows. Together, these forces are driving structural growth in creative workflows, and Adobe sits right at the intersection. The digital world is scaling fast and it's all content. We're seeing 14% annual growth in the digital content market through 2030, driven by the shift to video, social, and immersive media. Over 80% of creative professionals now use AI-enhanced tools every week, accelerating their output and raising the bar for quality. Meanwhile, video now dominates 82% of internet traffic, and platforms are flooded with demand, from TikToks to training modules. And with 4.5 billion social media users growing over 5% a year, the appetite for content isn't slowing down anytime soon. Meanwhile, demand for digital content creation isn't just growing, it's accelerating. By 2025, the market for content creation tools and services is projected to reach $32 billion, with momentum carrying it forward at nearly 14% annual growth through 2030. And it's not just marketers, it's educators, enterprises, influencers, and indie creators. AI and short-form video are reshaping creative workflows, and Adobe is right in the middle of it. It's not just for designers anymore. Adobe's tools are now used by business users, marketers, and even consumers to boost productivity, personalize content, and stand out in a crowded digital world. This expansion strengthens Adobe's competitive position. A broader user base means higher switching costs and greater relevance across industries, not just creative teams. That's a key reason Adobe's growth is proving durable. Now that we've looked at the big picture, let's zoom in on Adobe. This is a long-time staple in the creative world, but what's compelling today is how it's adapting. Adobe is no longer just for designers. It's using AI to help a wide range of users, from marketers to small businesses, create content faster and more professionally. Let's break down how Adobe is positioning for growth in this new era. What does Adobe actually do? It helps to break the business into three main parts. Creative Cloud is the most familiar, with tools like Photoshop, Illustrator, and Premiere Pro. These are the industry standard for content creation, deeply embedded into professional workflows, and relied on daily by creatives across industries. Experience Cloud is Adobe's enterprise software platform. It helps businesses use AI and data to improve customer understanding and deliver more personalized marketing. Document Cloud is all things PDF, from editing and signing to workflow automation. It's the smallest segment today, but growing as digital documents become the norm. All three segments generate recurring revenue, giving Adobe a strong foundation and optionality to grow from here. What drives durable compounding at Adobe? Adobe's long-term success boils down to a few structural advantages that make its business tough to disrupt and easy to scale. Leader in creative software. Adobe isn't just a player in the space. It's the default for creative professionals. Photoshop, Illustrator, Premiere. These tools are industry standards, taught in design schools, and used by agencies, freelancers, and Fortune 500s alike. Once you learn on Adobe, you tend to stay with Adobe. Deeply integrated into workflows. It's not just that people use Adobe tools, they depend on them. From content creation to approvals to publishing, Adobe's products sit right in the middle of daily work streams. That makes it hard to switch, especially when entire teams or departments are trained on the platform. Premium brand with pricing power. Adobe's pricing reflects its value. Customers pay up for software that's reliable, regularly updated, and enables them to do their job better. In return, Adobe gets healthy gross margins and strong renewal rates. Price hikes tend to stick because the software feels essential. Cross-suite synergies. Adobe's cloud products work better together. Integration boosts retention and wallet share as users adopt more tools across the suite. Let's talk about one of the biggest turning points in Adobe's history, the move to subscriptions. In 2013, Adobe made a bold shift. It stopped selling one-time licenses and transitioned Creative Suite to the cloud, launching a recurring subscription model. It was a risky pivot, but as the chart shows, it worked. You can see the inflection point just after. Revenues paused briefly, then took off once subscriptions gained traction, and haven't looked back. Today, over 90% of Adobe's revenue is recurring. That gives the business high visibility, strong predictability, and a setup we love to see in compounders: sticky products, tailwinds, and a model that strengthens with scale. So, how has Adobe actually performed since that major pivot? The numbers speak for themselves. Over the last decade, Adobe has delivered a strong 14% compound annual revenue growth rate. It's fair to expect some moderation. Adobe's now a $20 billion plus company. But the key point is this: with 90% of revenue recurring, a dominant software position, and strong content tailwinds, predictability stays high. And predictability is gold when you're looking for durable compounders. Margins are one of the clearest signals of business strength. Adobe's tell you a lot. What jumps out is the 88% gross margin. That's exceptional and reflects real pricing power and deep product stickiness, traits you usually see in mission-critical software. The big shift came in 2013 when Adobe moved from one-time licenses to subscriptions. Margins dipped, as expected with deferred revenue, but this pivot laid the groundwork for a far more scalable, recurring model. Today, operating margins have fully rebounded to over 36%. That's impressive, especially given the continued investment in R&D and AI. For long-term investors, this margin profile is what supports consistent reinvestment and compounding. If you want a shorthand for compounding power, return on invested capital is a good place to look. And Adobe delivers. After some lumpiness early on, especially around the business model transition, you can see how ROIC has steadily climbed, peaking above 50% in recent years. That's an elite number, and it tells you Adobe is not just growing, it's growing efficiently. What drives it? A capital-light model, high-margin recurring revenue, and tight discipline around acquisitions. It also reflects strong operating leverage. Once Adobe has built a product, each additional subscriber costs very little to serve. So while ROIC can bounce around year to year, the long-term trend here is what matters. Sustained high returns mean the company can reinvest at attractive rates, and that's the engine behind long-term compounding. Let's talk about cash generation and balance sheet strength, two of the quieter but critical ingredients in Adobe's long-term compounding story. First, the red line shows free cash flow conversion. Adobe consistently converts well over 100% of net income into free cash flow. That's exactly what you want in an asset-light, software-based business with minimal working capital needs. It gives Adobe real flexibility, whether reinvesting, buying back shares, or funding acquisitions. Now look at the blue bars, net debt to EBITDA. In Adobe's case, they're mostly negative, and that's a strength. It means the company has operated with a net cash position for most of the past 15 years. Even when it briefly dipped into debt, it quickly reversed. Put simply, Adobe generates more than it spends and doesn't rely on external financing. That kind of financial resilience is exactly what you want in a compounding business. Even great compounders carry risks. For Adobe, 3 stand out. First, AI disruption. Ironically, the same wave Adobe is surfing could also pose a threat. If they don't stay ahead of more agile, AI-native startups, parts of their product suite especially in creative tools, could come under pressure. Then there's enterprise budget cuts. The Experience Cloud relies on companies continuing to invest in digital marketing and analytics. If budgets tighten, those deals could slow, creating a drag on growth. And finally, platform dependence. Adobe's tools run across Apple, Microsoft, and Google ecosystems. That creates some exposure to gatekeeper dynamics, App Store rules, OS changes, or shifting priorities. One of these risks, potential disruption, is clearly weighing on the market today. Adobe's valuation reflects that concern. But over time, execution will determine whether those fears are justified. So if you're tracking Adobe, here are the numbers that matter most. First, revenue growth. The market expects high single digits, ideally 9% or more. Anything below that may suggest pressure in the model. Second, gross margins. At 88% plus, Adobe's margins are elite. If they slip from the high 80s, it's a red flag, potentially pointing to pricing pressure or cost creep. Third, free cash flow conversion. Adobe regularly converts over 100% of net income to free cash, showing a capital-light model and strong earnings quality. If that drops, it's worth digging in. These KPIs are Adobe's pulse check. If they stay healthy, the compounding engine stays on track. Adobe scores an 8.6 out of 10 on our quality framework, comfortably in high-quality territory. What's driving that? First and foremost, visibility. With over 90% of revenue coming from recurring subscriptions and deep integration into creative workflows, predictability is very high. Competitive strengths are solid too. Adobe dominates the creative software market and remains the go-to for professionals across industries. But there's always the risk of disruption from newer, more agile AI-native tools. Management effectiveness scores well, thanks to Adobe's consistent execution and capital allocation. The company has made bold, strategic bets, including M&A, to stay ahead, though big-ticket deals like Figma show that regulatory scrutiny can be a headwind. Financial strengths are decent, though a net cash position and strong margins are balanced against some build-up of goodwill from acquisitions. Resilience is the weak spot. Adobe isn't fully recession-proof, given its exposure to marketing spend, but the bigger concern is the pace of AI innovation, which makes disruption risk impossible to ignore. Let's bring it all together. First, Adobe is riding powerful structural tailwinds. The surge in digital content creation, especially video, points to lasting demand. We think this isn't a flash in the pan. Second, Adobe's strength lies in how embedded it's become. From creators to marketers to enterprise teams, it's not just a toolkit, it's part of the workflow. That kind of integration creates serious staying power. And finally, this is a high-quality business. With strong margins, predictable free cash flow, and a clear ability to adapt, whether through subscriptions or AI, Adobe looks well positioned to keep compounding over time. If you're enjoying this breakdown and want a clear visual summary, download the one-pager at compounding-academy.com. It's packed with the essentials: business model, metrics, risks, and what to watch. Perfect for keeping Adobe on your radar or pitching it to someone else. All right, that wraps up our breakdown on Adobe. If you're enjoying these focused takes on high-quality businesses, subscribe to stay in the loop. We're building a full library of breakdowns like this, designed to help long-term investors spot the real compounders. And while Adobe scores highly across the board on quality, keep in mind, valuation always matters. Even great companies can be poor investments at the wrong price, so we'll be covering that angle too in future pieces. If this was helpful, feel free to share it. And check out compounding-academy.com for more deep dives, one-pagers, and tools to help you make smarter investment decisions.